Good morning. Thank you guys for joining us for this webinar today. Just before we get started, wanted to go over a few housekeeping items pertaining to this webinar. It will be recorded, and if you are on this call or have registered and are watching later, then you will receive the copy of this recording and the slides in the next 48 hours. Those will be emailed to you. If you're experiencing any technical difficulties, if you can't hear the sound, or it's not letting you do something in the Zoom call, then just you can chat with myself or log out and rejoin the call. You can also join with your cell phone audio, I believe, as well. And then at the bottom of your screen, you should see a Q&A feature. This will be where you can submit any of the questions you have throughout the call. If we have a chance at the end of the call, then we will address those. Otherwise, you guys will receive a follow-up email directly from the presenters with your response within the next 48 hours after this call. So before they start, just wanted to introduce our presenters. These are two of our audit managers. Rick is out of our Savannah office and Tony is out of our Atlanta office. So guys, I will turn it over to you.
Thank you, Brittany. Good morning, everyone. Hope everyone's day is off to a good start. As Brittany mentioned, I am an audit manager in our Savannah office, and I also am the audit quality control leader for the firm. So I wear a couple of hats, and I've been with Symphona for just over a year and a half, and looking forward to sharing some lease information with you guys today.
Good morning. As Brittany mentioned, I am an audit manager out of our Atlanta office location. I have over 7 years of experience in the public accounting arena. My experience includes leading and performing multiple forms of attestation and audit engagements and providing other advisory services. Here are the topics that will be covered in today's webinar. I will have the privilege to go over the basics and goals of ASC 842, effective dates and getting started, and the primary lease types under ASC 842. Rick will cover the definition of a lease under ASC 842, practical expedience, and the next steps to consider for ASC 842 lease implementation.
And sorry, just to interject real quick, Tony,
Sure.
To all the participants watching today, this webinar, based on some surveys we've taken of our clients and just the pulse that we all have on our clients, this and just in the industry in general, where people stand on implementing the standard, we have found that a lot of entities have not gotten started or in the very early stages. So this course is actually designed for those who are getting started or are in the very early stages. If you've implemented already, there is a part on practical expedience, as Tony just mentioned, that still would be helpful. But I just want to put that out there before we get started. Thanks, Tony.
Thank you, Rick. So let's get started. So what is ASC 842? ASC 842 is the new lease accounting standard issued by FASB. This standard supersedes the previous ASC 840. The reason ASC 840 was replaced with ASC 842 was because under ASC 840, there were only a limited number of leases that were recorded on the balance sheet. An operating lease under ASC 840, for instance, was always an off-balance sheet type transaction. However, the payment obligation for an operating lease under ASC 840 represented a real liability and should be clearly presented to users of financial statements. Given the prevalence of off-balance sheet leasing activities, the lease accounting standard is intended to improve financial reporting, increase transparency, and comparability across entities. This new guidance will also require entities to disclose vital information about leasing arrangements to intended financial statement users. Again, for simplicity, the primary goals of the new accounting standard of ASC 842 are to streamline the accounting for leases under US GAAP, enhance transparencies into liabilities resulting from leasing arrangements, and to reduce off-balance sheet activities.
And I'll just interject one thing here too, as Tony just focused a lot on, right? The whole goal of this is to reduce the off balance sheet activity and get these get these leases, get these assets onto the balance sheet. This actually, believe it or not, came from, and I know this was an ASU back in 2016. So we've been hearing about this for six years or so. But it actually came to be that a FASB board member was on a Southwest flight and he was looking at their 10K and he asked himself, where are all the planes on the balance sheet? Because they had very few planes on their balance sheet because they were all under operating leases. And he said, well, that doesn't really reflect the true balance sheet, the true assets of Southwest. And then it got put into motion. So that's actually just an interesting little fact for any accounting nerds out there like myself.
So the basics, the effective date for private companies for annual periods beginning after 12/15/21, including all interim periods, fiscal years beginning after 12/15/22, with early adoption permitted. This generally means that for private companies, they should currently be working through the lease accounting transition now. There will certainly be challenges that will surface that you will not anticipate. We strongly encourage you to do it now and not wait until at the end of fiscal year 22 or after. The process may seem daunting, but you will have plenty of time to implement the ASC 842 before 12/31/22 and your yearly audit. Regardless of who your audit firm is, you do not want to be implementing the ASC 42 standard and going through your annual audit at the same time. You must be proactive, and so get started now. Are you prepared? Remember, even if you're not early adopting ASC 842 as of 1/1/22, you should already be accounting for the leases under the standard. So make sure you're ready and have a plan in place going to implement the standard. Things that you may want to consider as you prepare for ASC 842 implementation. Do you need lease accounting software? The general rule, if you have more than 10 to 15 leases, you would probably want to implement lease software. Will you use the full or modified retrospective approach? Under the full retrospective approach, the lease standard is applied to leases at the beginning of the earliest comparative period presented in the balance sheet, and therefore prior comparative periods on the balance sheet are adjusted. Under the modified retrospective approach, the lease standard is applied to leases at the adoption date, and recognition of cumulative effect adjustment to the opening balance of retained earnings in the period of adoption. Do you need assistance with implementation? We can help with that, whether that entails assisting with initial setup of leases or assisting with full lease implementation and even lease maintenance after implementation.
And sorry, just one thing to stress there too, because I know we've gotten this question from some clients about independence issues. This would not impair our independence. It's just like any other non-attest service we perform as for our audit clients. The most basic one, of course, is drafting your financial statements. So long as there's all the mitigating safeguards in place, if you're an audit client, we can still help you as long as you're making the ultimate management decisions and taking full responsibility for the services we provide. So again, I don't foresee any independence issues, and it would just be like any other non-attest service we provide. And we do provide a lot of non-attest services to a lot of our audit clients. So it would just be very similar. And to think about the fact that we keep depreciation schedules for a lot of clients. It would be very similar to that. Sorry, Tony. Thank you.
No, thank you, Rick. So let's talk about lease types. The primary types of leases under ASC 842 include finance leases and operating leases. The accounting for the finance lease classification under ASC 842 is consistent with the accounting for the capital lease classification under the previous standard ASC 840. The reason for this change is due to the capitalization requirement of most leases under ASC 842. The accounting for operating leases under ASC 842 has significantly changed compared to the previous guidance ASC 840. Under the previous guidance of ASC 840, operating leases were considered off-balance sheet type transactions. Rent expense was recognized in the income statement, but there was not any impact on the balance sheet. This made it challenging to understand the volume of lease commitments an entity entered into. Under the new guidance ASC 842, generally all leases must be recognized on the entity's balance sheet. ASC 842 requires the recognition of a right of use asset and a corresponding lease liability upon lease commencement. Under ASC 842, the expense of the right of use asset and lease liability are amortized off the balance sheet. Rick, I'm going to hand this over to you now.
Great. Thank you, Tony. Yeah, one thing that I just want to really emphasize that Tony talked about earlier was if you have not started your implementation, or you're in the very early stages, or you're waiting for your auditors, whether that be us or another firm, you really do need to get started now. If you think that it's going to be just an easy thing to do as part of the audit, oh, we're just waiting for the audit, the auditors will take care of it. That's not really the case here. It's very similar to any clients who had, well, everyone had to adopt ASC 606, but ASC 606 didn't necessarily impact everybody. This is going to impact everybody because just about every entity out there has at least one operating lease. So we'll get into some practical expedience and some relief on that. But I just want to be clear that you need to get started now, and don't think that it's too late. Just because it's the middle of September and we're almost to Q4, you still have a lot of time. And we'll talk about, Tony's hit on some of the things that you need to be thinking about and doing, and we'll summarize them at the end. But I can't emphasize it enough that it's something, and that's why we're doing this now, and that's why it is designed for people who are just getting started. Because doing the audit and working through an audit, again, whether we're your auditors or not, and trying to implement one of the biggest accounting standard changes in our lifetime is going to be very, very difficult. So just please keep that in mind. And we're here to help regardless of what other kind of services you provide. And if you're an audit client or not, we can certainly assist. We have people who are trained in this, and we're fully prepared to help. So as Tony described, there are now two types of leases under 842, similar to 840, but as Tony mentioned, the biggest change is coming with the operating leases and having to put that right of use asset and that lease liability onto the balance sheet. So that is in a nutshell, that is the biggest change of this whole standard. So it's no more just, it's an operating lease, we can just run it through the P&L. No matter what, it's going on to your balance sheet. So we have the definition of a lease here. So before you even decide if it's an operating or finance, formerly capital lease, you have to consider, do you even have a lease? So the definition is right there, right? A contract or part of a contract that conveys the right to control the use of identified property, plant, or equipment. That's an identified asset for a period in time in exchange for consideration. So there's some very key words in there. An identified asset. Do you have a clearly defined and asset that you can separate or is distinct? You know, it has to be an identified asset. Do you have the right to control the use of the asset? Is it at your discretion how you use the asset? Do you use all of the economic benefits or the majority of the economic benefits of the asset? And again, the right to direct the use, that is the discretion on how you use the asset. Period of time, we'll get into this in the practical expedience, but length of the lease does come into play. And there needs to be consideration. It says in the definition, time in exchange for consideration. So there has to be something given by the lessee, typically cash, to the lessor. So the first thing first, it's similar to ASC 606 when you had to say, hey, do I have a contract here? You really have to say, and we'll get into some things that will help you transition. But for anything new that you're entering into, you really have to consider, do I have a lease? 99 times out of 100, the answer is going to be yes. And then you make that distinction, which we will get into here on the next slide on how to determine that. So Tony described the differences a little bit between an operating and finance lease. Again, the biggest change here is that operating leases are coming on to your balance sheet. Finance leases are going to stay pretty similar, if not exactly the same, to how you were treating capital leases. But there were some changes, and we'll touch on those in just a moment. But I just want to highlight a few things here. So, and then you see on the slide that there's 5 criteria instead of 4, and we will go over that shortly. But the main thing I want to address here is the removal of the bright lines, if you will, which we'll discuss in just a second. And 842 has become more of a principles-based approach. I know that GAAP for years has been deep-rooted in a lot of bright lines, and IFRS, for instance, has been more principles-based, and we're continuing to see US GAAP shift out of bright lines and into more principles-based. And that's exactly what you have going on here with 842. It's more, there's no more line in the sand. You really have to kind of think and understand the standard to determine if you have an operating or finance lease. And there are going to be some benefits, as there always have been, and you saw in the past a lessee treating a lease one way and a lessor treating a lease another way to get that maximum benefit for themselves, you know, within the guidance that was allowed. But that's not so much the case anymore, because regardless of the fact, you're going to have to bring these operating leases on to the balance sheet. So lessees were often trying to treat them as operating leases so they didn't have to bring them onto the balance sheet. But that's no longer an option. There's one practical expedient, but it's very, very small. And while I'm thinking about it, I do want to just touch on this now. I think it might be a part of another slide, but just while I'm thinking about it and discussing the new treatment for operating leases, we are seeing some confusion already with regulatory agencies, and lenders. So, right, regulatory agencies and lenders both have sets of covenants or standards, right, that you have to be in line with. So you could have a debt covenant that does not allow your lease liability to get beyond a certain point. And, you can't have more than, say, $1 million of lease liability. Let's just use an easy number. Well, you need to make sure you're talking with your lenders and talking with your regulatory agencies to make sure that they understand these changes, because we're seeing in a lot of cases they don't. And that's presenting problems for clients because they're being required by the standard to bring on all of these operating leases onto their balance sheet, causing them to immediately blow a debt covenant because you're taking on all these new lease liabilities that didn't exist before, but you've always been in those leases. So it's very important, regardless of why you have your audit, but if it's being required by a bank or a regulatory agency, I highly recommend you touch base with them and you make sure that they have a full understanding of this. And they've been through it already with public companies. We've had some clients early adopt, but this is the biggest movement here now with all of the private companies being required FY22 to move over. So technically, as Tony said, you've already should have been accounting for this for 9.5 months, but we get it's not a perfect world. Things have been crazy in the world. We understand that. And again, we're just here to help, but just please keep in mind that you want to have these conversations now, or once you get your ducks in a row and understand what that lease liability is, you need to have those conversations if it's going to blow a debt covenant, or if it's going to throw a regulatory ratio, for instance, out of whack. You need to be considering those matters. So now we'll get into the 5 criteria for lease classification. Now this, the 5 criteria, this are for finance lease classification. And you're gonna see these are very similar to what existed under ASC 840. You'll notice there's a new one, a 5th one, but primarily the 4 from ASC 840 have, for the most part, carried over into 842. The transference of title or ownership to the lessee, a purchase option that's reasonably certain to be exercised. Please note here that it's no longer a bargain purchase option. It just has to be a purchase option. So whether it's a bargain or not anymore, you don't need to worry about that, because it's just a reasonably a purchase option that you're reasonably sure that you are going to exercise and eventually take ownership of the leased asset, or as it's called now, that right of use asset. 3 and 4 both go back to what we were just talking about, the bright line versus the principles based. So 3 and 4 are exactly as they were before, as far as the major part of the remaining economic life of the asset, and the present value represents substantially all of the fair value of the asset, right? Under 842, number 3, the economic life piece was 75%. And under 4, the present value piece was 90%. But the FASB did provide clarification on these, that in number 3, that major part is consistent with the 75% threshold under ASC 840. But again, And I'll just say this too, and they've also provided clarification on the number four, that substantially all is consistent with that 90% threshold. So those numbers, those percentage thresholds should sound very, very familiar to you. And what has happened here is they've removed the bright line. So if you're at 70% of the remaining economic life of the asset, you could still consider that a major part. It's not, there's no longer doing this test and saying, oh, we're 74.4%. We can round down to 74%. We don't meet any of the others. We're an operating lease. Well, that's not exactly how it works anymore. To me, if you're really at 74.4%, that is still considered a major part and should be treated as a finance lease. Same with the present value, compared to the fair value of the asset. For is 90%. If you're at 88%, you're like, great, that doesn't apply. I'm going operating lease. But because it's principles based now, if you're at 88%, to me, that's probably substantially all. But again, these are things that are now more subjective, and they're just going to take more judgment on your part, the auditor's part, everybody's part. So those are the four that existed in some manner previously. And then there's a fifth one that they added that makes a lot of sense, and it has to do with asset specialization. Basically, that it means that an asset is so customized and so specialized to the lessee that it would have no alternative use to the lessor at the end of the lease. So there would really have to be designed for a specific entity, because or if you're operating in a very unique industry or something like that, but typically an asset that would be that you'd be using would have some sort of benefit to maybe not the lessor, but maybe the lessor could to lease it out again. But if those aren't the cases, and it's so specialized, so customized, that at the end of the term, there's nothing else that can be done with this right of use asset, this asset, then you're going to go ahead and treat that as a finance lease. So even if you didn't meet criteria 1 through 4 that were consistent with ASC 840, and you have this highly customized asset, then you're treating it as a finance lease. But again, we'll keep driving this point home. Just because it doesn't meet the finance lease criteria and you have to put it on your books as an operating lease, it doesn't really, relieve you as much as it did previously, because it's still coming onto your balance sheet, right? You're still recognizing that asset. You're still recognizing that liability. And then there's more to the monthly entries than just recognizing expense and crediting cash, right? There's more to it now. So those are the 5 criteria that now will be considered for a finance lease. Some other important things to consider. Do you have embedded leases within service agreements or contracts? So this now really requires you to go out and review your service agreements and your contracts and see, is there something in the contract that actually gives you the right of use to a particular asset and where you have control over that asset? So it could be in a service agreement, some sort of service contract that you have with a vendor that you would have never thought about leases before, because you just have this service agreement But now it's causing you to take a look at those service agreements and look for what are called embedded leases. And again, the main thing there is that it gives you the use of a particular asset and you have control over the use of that asset. We're going to cover term here, and rate is also another important one. I would say rate is just as important as the term, but we cover the rate on some later slides. So we're just going to cover the term here. And as with a lot of things in GAAP, this is form over substance. So the term of the lease should be based on the period that the contract is enforceable, right? So there's 4 factors. There's asset-specific factors, contract-specific factors, entity-specific factors, and market-specific factors. So an asset-specific factor would be likelihood of a renewal. We have the example up here, office space with leasehold improvements versus a copier. If you have been in this office for a long time, you like the office that you're in, you like the part of town it's in, you have no desire to move, you've done a lot of work to the office, a lot of leasehold improvements, right? You're more likely to renew than this copier that we've had for 3 years and it keeps getting jammed and the guy keeps having to come fix it. You know, maybe you're not likely to renew that, even if there are some renewal options. And we'll get into that, the renewal options and how they impact the term of the lease. But these are just some factors to consider. And the next one, contract specific, is there monetary penalty for termination, or is there an incentive to renew, right? So if there's a penalty, if you're going to have to pay to terminate the lease, then you're probably not going to terminate that lease unless there's something really better or there are just a lot of problems. But in the same token, if there's incentive to renew and you're happy with this leased asset, you're more likely to renew. Entity specific, what do you use the asset for? Maybe you don't need it anymore. Maybe it was just for a specialized project. Maybe it was you were leasing an asset, but you cut that segment out of your business and you no longer need that asset. And then market specific is just, we're dealing with a crazy world right now where, we've come out of a pandemic, but it looks like COVID is going to be around for a while. There's rampant inflation. There's a lot of market factors to consider. So you have to consider how those market conditions impact you and your entity and your likelihood of renewing the lease. Because when you go to enter, when you get started on this and you're determining the lease term for an asset or a class of assets, these are factors you need to consider, because if you have renewal options and all these factors you've considered, they all lead to the fact that you're going to renew the lease for, say you have 2 renewal periods of 5 years, and you say, oh, I'm definitely doing the first one, and I'm still iffy about the second one. If you're less than 50% sure, you should probably just include that first renewal period of 5 years, just call it, right? So that would be a 10-year period, even though the original lease is for 5 years. If there are 2 renewals for 5 years each, if you're certain you're going to renew them both, then it should be a 15-year lease term. So it's not quite as cut and dry as it was under 840. So just wanted to point that out. And now I think this is probably the most beneficial piece of this presentation. And I think that this is regardless of where you are in the process. I think that these practical expedients, as they're called, are going to be beneficial for everyone. They were designed, as it says in the blue box. I'm sure everyone on the call knows what a practical expedient is, but just in case, I know it's up there for you, but it's an accounting policy election. That the biggest thing is that it provides relief from the burden on financial statement preparers to apply the requirements of an accounting standard. So the key words there are relief from the burden. The FASB understands that this is a big deal and a big change for private companies, and private companies aren't always equipped and don't always have the proper staffing in their accounting departments to necessarily make all of these new changes that they've implemented. So the FASB has given us 6 practical expedients that make life a lot easier on private companies that are in the process of implementing ASC 842. We do have highlighted on there too that it's a reporting entity is required to disclose the election of any practical expedients. Keep a note mind, we'll get to some financial statement disclosure issues at the end, but the selecting or the implementing of these practical expedients is an accounting policy election that would need to be properly disclosed in the footnotes as such. So the biggest practical expedient is it's called the group of 3. There's a couple other acronyms for it, but the main thing is all 3 of these listed on the white box. It's, as it says, it's all or nothing. You can adopt all of these, or you can adopt none of them. You can't cherry pick, ooh, I like this one, don't like that one. Unfortunately, I think it's fortunately, honestly, I think this is by far the best one. So let's get into it. And we're seeing a lot of entities want to use this, and I encourage it. If you have reasons not to and you would like to discuss, please, my email and my contact information will be presented at the end, so I'd love to have that conversation with you. But so the all or nothing, the group of 3. The entity does not need to reassess existing or expired contracts for lease classification. In other words, if you had an operating lease under 840, you carry it over under 842 as an operating lease. Capital lease, carry it over as a finance lease. You don't have to go back and reassess, based on those new 5 finance lease criteria. You don't have to go back and reassess for the classification. You just go forward with what you had. 2 things to keep in mind. Notice it says existing or expired. It does not say new. So if you entered into a lease as of 1/1/22 or beyond, assuming you are a fiscal calendar year, you have your calendar year is your fiscal year, right? Because a lot of 6/30 year ends, they won't quite be there yet. But if you entered into a lease for a 6/30 year end, it would be July 1st, of course. So we're already past that date. But for simplicity, we'll say calendar year. If you entered into a lease on January 2nd, it does not fall under this. Even if you've already put it on your books, and you haven't implemented 842, it would not fall under this. It would need to be assessed. It's only leases existing as of the date of implementation, and that date, even if you don't get implemented till January 31st, 2022, December 31st, 2022, that date's January 1st, 22. As we talked about before, embedded leases. So this group of three doesn't require you to reassess, I should say, existing or expired contracts for any embedded leases. Again, existing or expired, not new. And then initial direct costs under existing leases do not need to be reassessed under the new definition. So you would just treat those as such. And again, that is existing, not new. Now, these are 5 additional practical expedients. The ones in the white box are going to be the ones that I think most entities are going to want to adopt. I think they're the most helpful. The 3 in the blue are good if they apply to you, but the 2 to the right, and we're going to get into them all, of course, the 2 to the right are, I think, more important, more impactful for entities, and will really provide that relief that practical expedients are meant to do. So we will cover the ones in the blue real quickly. I know we have about 18 minutes left. So hindsight transition relief. So you can use hindsight in determining, various parts of the lease, right? And it's really the lease term, but that includes renewals, termination and purchase options, any impairment. You can use hindsight in determining these things, but we don't necessarily consider it extremely beneficial, or we have not considered beneficial on the screen, just because, as you'll see, certain practical expedients can be applied to certain asset class of underlying asset, not so with hindsight transition. So again, these practical expedients are accounting policy elections, and therefore you would be making an accounting policy election, and on this practical expedient, it would be applied to all leases. You could not do it by underlying asset category, which the 2 in the white box you can. Land easement, it's there. If you have land easements, know that there is transition relief for you. We don't see a ton of these, but if you do have one, by all means, reach out to me if you'd like to further discuss. Since we only have about 15 minutes left, I'm not going to go any further on that one. Short-term leases. So everyone still is like looking for outs, right? And people don't still, even though it's effective for pretty much everyone at this point, people are resistant to change. And the FASB even voted this year about delaying it another year, but I think they just said enough is enough. We've been kicking this can down the road for years. COVID or not, we're going for it. So people are still looking for, asking us, are there any outs to this? And the answer is really no. The only one that there is the short-term leases. So if you do have a lease that's 12 months or less, you can exclude it and treat it as you did a previous operating lease. This again would of course be an accounting policy election. So this would be how you, and as with the hindsight, this would be applied to all leases. It would not be done by underlying asset. But you can't, if you have a 1-year lease with 5 1-year renewal options, and you are more likely than not going to renew that second one, then it's not a short-term lease. It's not a 12-month lease because you are already saying, I'm renewing that. Month to month, there is some gray area there that we won't get into, but generally there is no way out of this. You're going to have to bring operating leases on to the balance sheet, because even if it's month to month, you're likely not going to get out of that lease in under 12 months. And therefore, calling it a short-term lease would not be appropriate. So the two main ones that I want to spend a few minutes on each is, I think these are going to be, I know these are the most, in addition to the group of three, these other two are the most beneficial. So combining lease and non-lease components. This, as you keep hearing me say, what's he talking about? This is where you can make this accounting policy election based on class of underlying asset. So you could say you pick vehicles and computer hardware and computer equipment. Say those are the ones you elect to do, you combine them, but the others you're not. So you can do that. So if it's office furniture, whatever other kind of assets you have, you wouldn't combine lease and non-lease components, but in the examples or whatever classes that you have chosen, you would combine them. And what that really means is it's really simplifying the standard for you, right? As it says on the slide, because you don't have to separate any non-lease components. And as it says on the screen, but if you're thinking what's a non-lease component, think about training, repairs and maintenance, security, operating the asset, right? All things that the lessor might assist you with during the life of the asset. So you can say, hey, on the computer hardware, if you have, or even software really, or anything, anything that comes with training, you don't necessarily have to break that training out. You don't have to break out the maintenance. You would just, and we do have one JE example at the end, and that does take this practical expedient into account. Because remember, the journal entries that your books are going to be booking really are impacted by the facts, circumstances, as all accounting matters are, but then really too, what practical expedients you elect to adopt. So I think this is a great one. It's meant to simplify the standard, but as I talked about earlier, do keep in mind that this will result in a higher lease liability because you're not peeling out that non-lease component. You're treating it as the same. So naturally, the lease liability and the corresponding right of use asset are going to be higher because you haven't peeled that out. And that's really going to play into when you have debt covenants or when you have ratios that you have to maintain for a regulatory agency. And this is why it's so important that they understand this, because if this non-lease piece that's added in were to blow your debt covenant, that'd be a shame that you couldn't apply this practical expedient because your lease liability becomes too high and you blow your debt covenant. So I think this is a prime example of why it's so important to be upfront with your lenders. And I know regulatory agencies are harder, obviously, and it's just more red tape, but lenders I've found will be understanding. Lenders get it. Lenders understand that there's a forever changing accounting landscape. And then the real big one, I think this is probably the best one, is next to the group of three, is it allows the lessee to use a risk-free discount rate. And again, just like the one we previously discussed, this can also be done by class of one underlying asset. And when you think risk-free discount rate, think treasury rates. That's a great example. That's where we recommend to our clients that they get their risk-free discount rate. So and then of course, as with everything, what we say this, we mentioned ASU 2021-09 because what that did was it allowed you to apply it to class of underlying asset before. And I pointed out because this was kind of slipped in at the very end of 2021. And I know a lot of people missed it. So I just want to highlight that and just let you know that if you need any more information on that, go check that ASU out. But at the end of the day, what this is meant to do is eliminate the need to determine incremental borrowing rate. So you don't have to go determine the incremental borrowing rate. You use that risk-free rate. You use that probably treasury rate. And remember, you have to use the rate applicable to the lease term. If you have a 5-year lease, you should be looking for a comparable risk-free discount rate, a 5-year rate. But if you have a 30-year lease term, then you should be looking at a 30-year, treasury rate. As with the previous one, it will result naturally, right? If you're using a risk-free discount rate, it's going to be lower than your incremental borrowing rate. So again, it's going to result in a higher lease liability and right of use assets. So now you can see why it's so important with lenders and regulatory agencies, because again, it could cause you to blow a debt covenant. And I think this is both of these are really great. And it would be a shame for you not to be able to apply them if it's going to cause issues with your lender or your regulator. I think we've talked about the fact that this is done by class of underlying asset. So you can, we have an example here, high volume, low dollar leases such as office equipment, right? But the main thing to understand, or not the main thing, but another thing is, and I know we just got a couple more slides, so I think we're really good on time. The main thing here to understand is, even if you have adopted this, even if you make this accounting policy election and you elect to apply the risk-free discount rate to vehicles, let's just say, I'm just using a simple example. That's great. You can apply the risk-free discount rate to every vehicle you lease in your fleet, unless you already know the implicit rate. If you know the implicit rate of the lease, and that's readily determinable, you have to use that rate. You cannot use the risk-free discount rate. So what this practical expedient is meant to do, as it's explained in the slides, it's to eliminate the need to determine an incremental borrowing rate, because that involves looking at all the different debt you have, all the different pieces of debt you have, and kind of honing that rate in based on what it would cost. And this is how capital leases were treated, right, for years. You had to look at your debt and what would that rate be if you were to go out and actually buy or lease that asset. So if it's known to you or readily available, determinable, that is the implicit rate on the lease, you cannot use this risk-free discount rate. Practical expedient. So some items to consider for financial disclosures, and I know we only have a couple minutes left. So the main ones I want to highlight here is in the first full annual period after the date of adoption. So if your adoption is 1/1/22, there is an exemption for quantitative disclosures normally required by ASC 250. And the main ones are, you would normally disclose the impact of an accounting change, the impact on, income from continuing operations, net income. You can read the others. You're exempt from doing that. And this does extend to interim periods, although for any calendar year, you're pretty much done with interim reporting because it's almost Q4 of 2022. And then the bottom one, finance leases, we'll get into this a little bit in a second. Finance leases have interest expense. Operating leases, there isn't interest expense. And we will cover that. So just so you know, so we'll cover that, and then we'll wrap it up, and we'll summarize and wrap it up just in time here. So so we were just talking about the financial disclosures and interest expense specifically versus non-interest expense. So your finance lease entries are going to be identical, we'll say, to your capital lease entries. There's not much change in there. It's the operating leases, right? That's what we spent a lot of our time talking about. And so what you're going to do on day one is, and this does assume that you have the combining lease and non-lease components, that you did adopt that practical expedient. And this is just very high level to get you thinking about it. This isn't meant to present any specifics. There's no numbers, but just to get you thinking about it. Day one, you debit. It's going to be a new asset class, right of use asset, and then you credit your lease liability based on the present value of the future minimum lease payments, right? That's bringing the operating lease onto the books. Should sound very familiar. It's what you've been doing with capital leases all along. And then the next entry, there's actually two. So day two, or subsequent to day one, whenever you record it, there's some monthly entries. 2 entries are going to be required of you. And again, this is assuming most of the practical expedients, because if you don't adopt all the practical expedients, they're not going, your entries are going to change. And that's why we have said it depends on facts and circumstances and what practical expedients you adopt. But the entries going forward and then recurring will be, as you always have, you record the cash payment so that when you dole out that cash, you actually credit cash, obviously, but then you actually debit the full amount of the payment for the lease liability. But then you'll see there's a true up when you go to record lease expense. So when you record lease expense in that same motion, say the monthly payment was $5,000 and you just debited your lease liability and credited your cash. And I know we're at 11 o'clock and we have about just 2 minutes left. So I apologize, but please hang with me and we'll just summarize what the next steps were. But I do think this is important and valuable. That second entry, you're going to be debiting the lease expense for that same amount. So if you made a payment of $5,000, you're going to debit lease expense for $5,000. The credits come in. So instead of, as we've talked about, instead of interest expense, there is no actual interest expense, but there is an interest calculation essentially. And what you do is you take that calculation and you accrete that to your lease liability, therefore increasing your lease liability back, right? Because the first entry you just did on day 2 or the end of the period was you wiped out $5,000 of lease liability, but you have to accrete back part of that lease liability, and then the plug credit, if you will, is just going to the right of use asset to get that off the books. I know that's a lot. It sounds confusing. I'm sure it's not. We're here to help, and we're glad to get further into that. But just with an hour-long session, as you can see, we're already a minute over. So there wasn't the time. But I will say real quick, I know I'm getting the music to get off the stage, but just summary real quick. You want to get started now. Take an inventory of all your existing leases your entity has. Determine if you need lease software. Determine if you need help of a CPA firm. If you're doing this on your own, consult with your auditors prior to the audit to ensure they are on board with your methodology. Determine which transition method you will use. Decide which, if any, practical expedients you will apply. And that's it in a nutshell.
Awesome. Thank you so much, Rick and Tony, for presenting this information. Like you said, I know there's so much information to cover on this specific topic, but here on the screen, you should see their contact email, their phone number, and our website that you can go to if you have any questions. Again, you can, before this call ends, jot something into the Q&A and they can get back with you, or jot down or screenshot your screen and you can have their email addresses to reach out directly with them. Thank you guys for presenting, and thank you to everybody that joined our call today. Hope y'all have a great day.
Thank you, everyone. Take care.